Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Monday the 31st of March here in London. I'm Caroline Hepker.
And I'm Tom McKenzie. Coming up today, stocks drop and bonds rise as the prospect of a full-blown trade war drives the Nikkei into a correction.
Donald Trump says his plan for so-called reciprocal tariffs will be universal. It drives Goldman Sachs to predict more rate cuts.
Plus, still seeking a carve-out, Starmer holds what his team call productive discussions with the US president ahead of looming levies.
Let's start with a roundup of our top stories.
The Nikkei 225 index entering a technical correction, dropping 12% from its December high. As expected, tariff announcements push global stocks into a sell-off. Money managers around the world are de-risking their portfolios or refraining from taking big positions as they remain wary about the announcement of so-called reciprocal tariffs and the impact on the economy. Jamie Niven, senior portfolio manager at Candriam, told us the market is starting to contemplate the negative impacts.
It will impact global growth. So there's no doubt about that. And I think the other thing that's really important to note is the uncertainty around tariffs and how that impacts the US consumer and US corporates. And I think that's what the market's starting to focus on a lot more rather than maybe previously where the focus was on the inflationary aspect.
Candriam's Jamie Niven there speaking to Bloomberg Radio this morning. Bonds are rallying with 10-year Treasury yields dropping currently little over 5 basis points, currently yielding 4.19, so below 4.20 on the benchmark US 10-year. In commodities, bullion, as Caroline was saying, gaining as much as 1%. Currently, gold trading at $3,122 per troy ounce, up 1.2% in the session at a fresh record high.
Well, the market moves come as President Donald Trump has said that no country will be exempt from his so-called reciprocal tariffs plan, which is to be announced on Wednesday. White House officials have insisted that the levies would be more targeted, with some nations being excluded. However, speaking on board Air Force One on Sunday night, the president pushed back on the idea.
You'd start with all countries, so let's see what happens. There are many countries involved. I haven't heard a rumor about 15 countries, 10 or 15.
So you're starting with all countries?
Well, essentially, all of the countries that we're talking about. Wouldn't be talking about all countries. It's not a cutoff.
President Trump has indicated the plan will go beyond matching tariffs that other countries levy on US imports to include things like value-added tax and also regulations that the White House sees as unfair. Research from Bloomberg Economics shows that if Trump were to adopt this approach with the 15 trading partners who have the largest deficits with the US, tariffs could rise by up to 28 percentage points over current average rates, and that would deliver an estimated hit of 4% to US GDP and lift prices in the country by close to 2.5%.
Well, Trump's decision to double down on sweeping tariffs comes as he also insisted he doesn't care if the cost of imported cars rises. In a phone interview with NBC News, he said, quote, "I could not care less if they raise prices because people are going to start buying American cars." Speaking to Fox News Sunday, Trump trade advisor Peter Navarro said the auto tariffs would raise significant revenue.
We're going to raise about $100 billion with the auto tariffs alone. What we're going to do is, in the new tax bill that has to pass, it absolutely has to pass, we're going to provide tax benefits, tax credits to the people who buy American cars. This is a genius thing that President Trump promised on the campaign trail.
Despite Navarro's upbeat assessment, auto prices are broadly expected to increase by thousands of dollars as a result of the levies. JP Morgan analysts estimate prices will jump 11% on average. Speaking this morning, European Central Bank President Christine Lagarde said the tariffs will hurt global growth and are a chance for Europe to show its independence from the US.
UK Prime Minister Keir Starmer spoke to Donald Trump as Britain tries to escape the looming global tariffs. A statement from Downing Street says the two leaders held productive discussions and they will stay in touch in the coming days. Home Secretary Yvette Cooper was asked if the UK would retaliate if it didn't get a deal.
The Prime Minister has said that no option is off the table and we will continue to approach this in the UK national interest. That's the important thing.
The British government has been working for months on strengthening relations with the White House and is considering cutting digital taxes to secure special treatment. President Trump posted online about the call but didn't mention trade. Instead, he said that Starmer had told him 3 people who had vandalised his Scottish golf course had been imprisoned. So far, the UK has been hit by the same levies on steel and autos as the rest of the world.
Goldman Sachs economists are forecasting more interest rate cuts this year. That's as President Trump's trade policy threaten global economic growth. Bloomberg's Tiwa Adebayo has more.
Economists at Goldman Sachs now see the Fed cutting in July, September and November. That's compared to earlier bets on 2 cuts this year and 1 in 2026. In Europe, a separate note said lower growth forecasts reinforce expectations that the ECB will lower rates in April and June, with a further 0.25 percentage point reduction now seen for July. The news comes as researchers at the bank increased their tariff assumptions for the second time in less than a month, meaning they now expect the average levy to rise 15 percentage points in 2025. Higher consumer prices and lower GDP growth in both the US and EU are also in the firm's forecasts. In London, Tiwa Adebayo, Bloomberg Radio.
President Trump has threatened to punish buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. In comments reported by NBC News, Trump said that he was very angry and threatened curbs on all oil coming out of Russia. Speaking to journalists on Air Force One, the US president, though, was more moderate.
I was disappointed in a certain way. Some of the things that were said over the last day or two having to do with Zelensky, because when he considers Zelensky not credible, he's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that.
The threats mark a significant change of tone for Trump and reflect a growing frustration in the US administration. Russia is one of the world's 3 largest oil producers, meaning that any attempt to punish buyers could have far-reaching effects on both the oil market and also on inflation.
To France, where National Rally's Marine Le Pen will find out today whether she'll be banned from running for the French presidency in 2027. In the coming hours, judges in the country will rule on an embezzlement case that's put the political future of the far-right leader in jeopardy. An immediate ban, sought by prosecutors, is a very real risk for Le Pen if she and her party are found guilty of diverting millions of euros in EU funds to finance activities related to their domestic agenda.
And those are our top stories for you this morning. Let's have a look at the markets then. European stocks are currently down by 1.1%. So tumbling this morning, even though we've had a very strong quarter versus the US. German 2-year yields are also on the back of these tariff worries, falling now 6 basis points in terms of yield, so rallying to 266. US yields on a similar footing, down by 6 basis points at 4.19 in terms of the 10-year yield. The 2-year yield for Germany is now down by 5 basis points. You've also seen money going into gold, so the gold spot price is surging 1.2%. The Bloomberg dollar spot index is down by 0.2%. The euro is higher, trading at 1.0843. That is a look at the markets in what is a very important week for these tariffs. So we'll be looking at that in depth now.
OK, let's bring in at this point then, of course, to focus on the tariffs as we lead up to April the 2nd and what, of course, President Trump has described as Liberation Day. Valerie Teitel, of course, our markets reporter, and Bloomberg's FX and rates reporter, Alice Gledhill. Valerie, let's start with you then on the here and now of what is proving to be and shaping up to be a brutal sell-off in Asia and now in Europe.
Yeah, that's right. It seems to be that the U.S. markets are very close to taking out the lows of the year. The year-to-date lows on March 13th are less than 1% away when it comes to S&P 500 futures. The equity market is definitely on a shaky footing ahead of the big tariff announcements and the big data prints that we do get out this week. It's interesting to see, I know you noted in your market check, Caroline, that this risk-off tone is not seeing a bid into the dollar, which is very interesting. At least to me. Normally in scenarios where you see equity market weakness, when you see treasury yields declining, it does, you also see a safe haven bid into the dollar, but no, we're seeing it strongly in the gold price instead, up more than 1% so far this morning, trading near record highs for the yellow metal. I think this is all down to the fact that the Fed has basically told us they could look through some short-term surge in inflation on the back of tariffs to protect the labor market, which means we could have a scenario where the economy is weakening and we have inflation. And in that, guys, you want to be holding commodities, gold being seen as the top winner in that stagflation kind of trade.
Yeah, although things are very uncertain, aren't they? So perhaps we'll get more into the Fed and the ECB policy outlook in a moment. Alice, can I bring you in, though? I mean, all the major sectors in terms of equities in Europe are now in the red, but you've also seen very significant moves in terms of European bond markets, and it does seem to be this battle between the kind of fiscal spending that Germany has announced versus what the tariff impact might be.
Yeah, exactly. I think that's kind of what marks Europe out here. So we've pivoted from this euphoria, I guess, kind of towards the start of the month when Germany announced this sort of historic, huge spending package. And, they're planning to invest billions of euros in infrastructure and defence in the next 10 years or so. And, that drove the euro to about 110. It was toying parity sort of, as just a couple of months ago. European stocks are on track to post their best quarter again versus the US for many years. But over the last week or so, kind of as this April 2nd Liberation Day approaches, we've seen a flip in terms of risk appetite. That's really boosted government bonds, and you're seeing a strong bid this morning, and the euro's sort of come off its highs as well.
And that maybe some of that seems to kind of justify, or at least will give credence to the calls from Goldman Sachs that the ECB and the Fed will have to do more and at a quicker rate. So they've now changed their forecast. So they say now three cuts from the Federal Reserve this year, 3 additional cuts from the ECB. Talk to us about how they've changed their view and kind of what underpins that assessment, Alice.
Yeah, so the impact of tariffs, as you say, is so uncertain. I think clearly there's concerns around the hit to growth, but there's also concerns about whether this is going to drive inflation once again. I think for now the concerns are focused more on growth, and that's why you're seeing this kind of flight to havens at the moment. Just in terms of kind of the number of cuts coming from the ECB and the Fed. In the US in particular, there's been this sort of tennis match kind of for much of this year and last year, sort of how much the Fed is going to do. Kind of 1 month they're going to be cutting 3-4 times. The next month, no, they're not cutting at all. But I think the fact that we're now seeing some of these banks kind of come out and change their forecast, and linking that to the tariff shows that they're really quite worried about the impact on growth in the short to medium term.
Although, Valerie, speaking to Jamie Niven, you heard a little snippet of his interview with us just earlier, senior portfolio manager at Cantor, and he put something interesting, and this goes to your point, Alice, that you might basically see no cuts at all, or 4 or 5 cuts in the space of a year. But it's actually that middle ground that looks least likely, because you'll either have a kind of big tariff impact or maybe you won't. I mean, and you could see Jamie Niven's reaction to the Bloomberg intelligence view of the impact on GDP from the tariffs, the cut to GDP, the 4% GDP impact that Bloomberg Intelligence sees if the kind of maximalist approach comes true. It would make a big difference, wouldn't it?
Yeah, I think a lot of people are also pointing out the Atlanta Fed GDP Now forecast, which is a current forecast of GDP for the current quarter based on the data that we've gotten. It's now at a negative 2.8%, Caroline. It went way lower after Friday's data. So again, you're seeing, the street marking down their GDP growth forecast, Goldman being that one, doing alongside a call for more cuts. But what I found really interesting in that Goldman Sachs piece, they also upgraded their core PCE. That's their metric of inflation, the one that the Fed tracks, from 3% to 3.5%. So they are forecasting a stagflation environment, one that the Fed cuts into. And this is where we have to think about timing. Do we see the impact of tariffs show up in inflation before we see some weakness in the labor market on this overhanging uncertainty? Because that could cause quite a pickle for the Federal Reserve. Could they really have the guts to cut into surging inflation because they think of this damaging, the long-term growth trend of the U.S. economy? Or are they going to hold off until they see some weakness in the labor market, which then again could cause maybe even more damage to the U.S. economy if they don't, introduce some more easy policy?
Val, as we think about how to find havens in this volatile environment, the 60-40 portfolio has come back, at least for now. So that's standing out in terms of the divergence between the performance of bonds versus stocks.
Yeah, I found that really interesting that this quarter is the first quarter since March 2020 where we've seen stocks being hit alongside a treasury market rally. So it's been 5 years since we've been absent of this traditional correlation. But people are questioning, though, if we are headed for a U.S. recession. Normally in a U.S. recession, recession, the deficit balloons. We could be facing a 13% recession, a 13% deficit in the next recession, because the current deficit is 7%. So you add 5 to 6 based on historical analysis of what that could end up being. Do you really want to be buying treasuries if the U.S. government has a 13% deficit? It's a lot of questions being raised on whether on a recession we do get a big treasury rally.
Alice, I'm going to leave you with the last word. What do you think that investors and traders are going to be thinking about this week? Because although we've got some kind of analysis of what the impact on the U.S. might be, for all the other countries, it's still very, very unknown because we don't know the shape of the tariffs. Does that mean more volatility? What do you think it means for markets this week?
Yeah, it's an interesting one because just in terms of sort of market-based gauges of volatility across different asset classes, they've actually been pairing over the last week or so, and I think that's a sign that actually investors just don't really know how to trade this. As you say, it's the outlook is so uncertain. We don't know what Trump's tariffs are going to look like. We don't know how other countries are going to retaliate, and I think on that basis, people are reluctant to kind of place big directional bets either way. And I think we'll probably see more of what we're seeing today, i.e. this flight to safety and this risk-off, very sober sentiment in the market.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.